Good afternoon, everyone. My name is Pamela Hastings, Relationship Manager at Barometer. Joining me, as always, is David Burrows, our Chief Investment Strategist and President here at Barometer. On today's webcast, we will provide you with a brief macro overview, and of course, we would be pleased to address your questions at the tail end of our conversation. So don't be shy, email me at phastings@barometercapital.ca or hit me up via the chat on the Zoom link. And with that, I turn the conversation over to David. Good afternoon, David.
Hi, Pam. How are you?
I'm well, thank you. How are you?
Just great, thank you. I want to welcome everybody onto the call today. I was away for a week last week, so we had a rare Tuesday where we had no webcast, and so I want to thank everybody for joining today. Certainly lots continuing to go on in the world. And, if we watched the news every night, one would think that this market would be in a lot of difficulty. And while it has not been easy so far this year, I think that there are a lot of important clues that we can take away, not so much from the news itself, but really how the market has been reacting to the news. If you think about just the past week, the Fed has signaled that there might be as many as 7 rate hikes over the course of this year, and that we should continue to expect rate hikes in 2023. There are really no near-term resolutions apparent in the Ukraine. China continues to have difficulty in their economy. There are new waves of COVID in various parts of the world. And oil, omnipresent in the global economy, has continued to be very firm. Some may be putting pressure on consumers and adding costs to the system. So lots of things to be worried about, yet last week, we had 4 consecutive days where the S&P was up over 1%, and where 77% of all the volume on the course of that 4 days was up volume, meaning buyers reaching up to pay higher prices to buy in positions. So let's talk a little bit about what's going on in the background. As always, I want to start from a high level, because at the end of the day, 80% of return in a portfolio comes from getting the asset class call right, and then within the asset class, finding the right groups or themes to focus in, and then 20% of return is finding very specific securities to express your view. So we like to take the message from the market, and we have had the view that the backdrop for equities in general globally has been positive over the last number of years. The US started a secular bull market in 2013, and we have been in one ever since, despite the fact that there have been some short, sharp pullbacks. It's a lot like what happened in the 1980s and 90s. It's a lot what happened in the 1950s and 60s. Now, lots of people like to say that stock markets can't go up when rates are going up. I just want to highlight that in 1951, the yield of the 10-year bond was 1.6%. By 1966, the yield was about 6.5%. And despite that, stocks went higher all the way through the piece, because frankly, the economy was improving. It was reflating after the war. There was solid demand and there was solid profitability. So we're going to talk a little bit about that as we go along today, but equities backdrop has been favorable. In the long-term chart, this is the S&P back at the beginning of the bull market, 1981, has had over the period lots of periods of wobbles until we got to 2000, when we entered a structural bear market. And the structural bear market went on from 2000 through 2013, where essentially the S&P made no progress. These are real bear markets. These are not real bear markets. Yet what we've just gone through, about a 15% pullback in the S&P, certainly felt painful. In the NASDAQ, I suppose if you use the 20% rule as a bear market, I suppose that it has had a bear market. But the net of it is the investors have been very, very nervous. But when we look at where things are in the scheme of structural bull market, what we've seen has been very, very normal. In the fixed income world, we know that yields have been falling since 1981. And we have had a view that we had gone through a bottoming process in long-term interest rates. We probably were going through a bottoming in rates in 2016, 17, 18, and then the pandemic came and knocked the pins out from underneath interest rates and inflation expectations. But realistically, since then, we've seen yields working their way higher. We put this up in the video 2 weeks ago. This was the bottoming in yields in 2020. We retested the yields low in the summer of 2020, and they've been working their way higher. They consolidated, this is the yield on the 10-year bond, over the course of the period from sort of April of 2020 through April of 2021. December 2021, and we started moving higher from there. Now, in the early part of this year, yields pulled back a little bit. We made the case this was probably just a check back after breaking out. When we look at them today, it does appear that that was the case. We have had another sharp move higher, and this, of course, on the heels of the Fed's quite hawkish testimony last week that we should expect additional interest rate increases through the course of the year. The market is now discounting about a 75% chance that we get 7 interest rate hikes over the course of the year. And that, of course, is not that favorable across the curve. And we've seen bonds selling off as a result. So this is the TLT. This is the high in the price at the long end of the US bond market. Since 2020, the TLT is sold off about 28% from top to bottom. More importantly, recently, we broke 1 area of support, 2 areas of support, 3 areas of support, 4 areas of support to break below those yields. And we talked about over the last few weeks, our view is that yields can go fairly significantly higher, and it's not going to happen in a straight line. But this has a real message for bond investors. After 40 years of falling rates and supportive interest rate environment for a bond investor to get their coupon and then perhaps get some capital gains on top, we are not seeing that as it is sit today. Despite the fact the stock market has been difficult since December, bonds have been not any better. So their historical role during falling rates of a shock absorber in the event of volatility in the market just is not playing out. So it's our case that when you go through a secular end of a secular bull market, it takes investors a long time to accept the fact that something perhaps has changed. We would make the case it's pretty clear something has changed, and there is a mountain of money in the bond market that doesn't have to be there. There's lots that has to be there, and insurance companies and banks and governments who hold them as collateral, like China has and like other countries have. But there's a lot of discretionary investors who have chosen to hold these for various reasons. And my guess is that we are starting to see some of that money leak out of the bond market in search of something better, given the fact that we're in a more inflationary environment. If you look at the aggregate bond index, which is an aggregate of bond issuers and maturities and credit qualities, it's a shorter duration basket of bonds. It's down about 13% off the highs, and that would be representative sort of the bond market as a whole, and really no sign that it's finding a bottom here. And when we look at international Treasury bonds issued by governments around the world, again, down about 18% from the highs. Now, of course, there have been some coupons that investors have had along the way, but really we know that the yields on bonds are exceptionally low. They're at generational lows and really not much solace. So money is moving. And I would say that for those that believe we are headed to recession, the bond market is not signaling this. At this point, with yields going higher so sharply, one would expect if we were headed to recession, you might be seeing yields move lower. And that's just not the case. If people really felt that the best place they could be was bonds, you would see money rotating to bonds, just not the case. Now, on commodities, we made the case that we've been seeing a generational bottoming in yield in prices. We know that commodity prices fell on an absolute basis, just falling in price since 2008. But in fact, falling in real terms, inflation adjusted, since around the year 2000. And we've seen over the last 2 years a significant pickup in commodity prices. And this is a basket of a variety of commodities, equally weighted, not just dominated by energy. But we've been making a case that really we've been going through a period where commodities were bottoming relative to equities after a very long period of underperformance, and that when the turn comes, they can outperform for a long period of time. So it's possible, if we are in a more inflationary world, and if it's possible that commodities have been a difficult place, not just for investors to put money to work, but corporate executives to put money to work to build capacity, it's possible at the exact time there's a shortage of supply, there's no new supply coming on, and the bottlenecks are causing a problem and causing a catalyst. When we take that same chart and look at it relative to the S&P, we can see that since June of 2020, the relative strength of the RJI index has been rising sharply versus the S&P. So that feels like a long time, 2 years, but when we put it in context, it's really not very long in relation to how long it's underperformed versus the S&P. So when we look at some key components within commodities, they continue to perform well, but we want to keep in mind we've only just exited a bear market in oil that goes back to 2014 when oil topped at $140 a barrel, and certainly just breaking out of that long sideways range, much like stocks did in 2013, or if we go back to 1951. But putting it in context, energy has been underperforming the S&P dramatically. In fact, if you went all the way back to 1925, there has not been a time where energy underperformed so dramatically. And so the fact that we're seeing a bounce really means nothing about how far it could go. Remember that the XOP, or the Energy Producers Index, fell 90% between 2014 and 2020. The fact that it's having a good 18 months does not mean that this should be over. Now, we know that the Cushing supplies are getting very, very low. We talked about this 2 weeks ago. It's a chart we put up. From the API data, 22 million barrels in inventory. That's interesting when you also realize that the US Strategic Petroleum Reserve has been being sold down and is at about the lowest level it's been at since 2005. So between the Cushing supplies and the petroleum reserve supplies, and a world where we are likely to have further constrained supply coming out of Russia, and Iran continues to be uncertain, it's not impossible that supply demand could be out of whack for a while. Outside of energy, the base metals continue to be very strong. You can see rising relative price strength versus the S&P. Now, when we look at that again against the long-term picture, we have to go back to 2011 at the beginning of the bear market to have been at similar levels, and we've only just broken out of the range that it was in over the course of that 11 years. So base metals pulled back very slightly over the last week, but still just beginning what looks like a new bull market. Grains, we put this chart up last week. We had pulled back a little bit. There was a bit of a sloppy week in the market leading into last week, but grains moved sideways. We're above all long-term moving averages. Grains continue to be quite favorable. Gold broke out of a very significant consolidation and broke out to the upside out of a cup and handle. And so realistically, we are seeing great strength in some of the basic materials. Now let's go back to the S&P for a minute and look at it, take it from a very long-term picture, take it to a shorter-term view. So the S&P sold off about 14.8% to the lows on February the 24th. We know that when the market made a low on January the 24th, sentiment got very weak very quickly. The market rallied, failed, and made a lower low when the Russians went to war with the Ukraine. As of 2 weeks ago, we were holding just above these lows. We made a comment that volatility really wasn't telling us that we were about to go lower. Each spike lower in the S&P was being met by a lower high in volatility. In other words, market was discounting less risk, even though the market was making lower lows. Well, here we sit 2 weeks later. The market's had a pretty sharp rally off the bottom. We're back sitting above the 200-day moving average. And volatility since then has sold off dramatically. So I would say that volatility selling off the way it has over the past 2 weeks tells us that likely the short-term fever for stocks is breaking. But that's just one indicator. Let's talk a little bit about our data. Now, we talked about sentiment being weak and that often marks near-term lows. If you were to take the sentiment last week, it exceeded the bearish sentiment from March of 2020 at the COVID low. Now, market hasn't pulled back anywhere near what it did in the COVID sell-off, but investors got very bearish very quickly. We talked about the fact that cash positions had been raised and that the exposures in institutional portfolios and hedge fund portfolios had been brought down quite sharply. What we really care about is what's happening inside the market. We care less about what's happening in the index itself. We want to know over time that whether the percent of stocks in long-term uptrends is expanding, which is healthy, or deteriorating. We know through most of last year, the market narrowed. There were some notable pockets of strength, but some notable areas of weakness. In February of last year, we saw unprofitable technology companies and the story stocks, the meme stocks, start to sell off. It worked its way through a number of growth stocks through the course of the summer. And by late fall, many of the largest, best held growth stocks started to get impacted. So what we care about is in a healthy market, the percentage of stocks participating to the upside should be expanding. That's a healthy market. That's when we want to be putting new money to work. And when breadth is deteriorating, we want to be cautious. We want to make sure that our stop losses are set at reasonable levels. If we get stopped out of existing positions, that's fine. We'll raise some cash. We won't put new money to work till we start to see breadth expand. So 2 weeks ago, we noted that while our long-term indicators were positive in the US and Canada, globally they had weakened, most notably in Europe, and that some of our short-term indicators are showing some weakness. Well, let's fast forward 2 weeks. The short-term indicators have started to turn positive again. In fact, they did early last week. So percent of stocks trading above their 50-day moving averages actually last week moved from 30% to 55%. So over half of the stocks now on the NYSE are trading above their 50-day moving averages. When we look at the percent of stocks with positive weekly price momentum, moved higher as well. And the percent of stocks trading above the 150-day moving average, moving higher. But the way that's happened, I think, is very important. Now, if we look at sentiment versus positioning, again, the news versus what people are doing about the news, we know that sentiment has been exceedingly weak and positioning has come down a little bit. In other words, portfolio allocations to equities have been reduced, but nowhere near what we've seen in other major problems. So it tells us that while people are concerned about risks, when it comes to actual decision-making, they're staying relatively invested. And I think that that's an important distinction because in the most significant bear markets, like for instance, 2020 or 2018, positioning changes quite dramatically, but in this case, positioning has remained pretty benign. Let's look at what's happening internally. Early last year, January of 2021, the percent of stocks in uptrends was 60%. Now, on these charts, when we're in a column of X's, it means that percent of stocks doing well is rising. And when we're in a column of zeros, it means the percent of stocks performing well is falling. So you can see through the course of last year, March, May, August, October. In each successive little sell-off, fewer and fewer stocks were holding their long-term price trends. We saw a series of lower lows in the percent of stocks and uptrends until February, when we made a low at 32% and reversed higher. Now, this is the first higher high we've seen since the beginning of the correction in January of last year. So this is the global universe of stocks. We give each company a single vote and calculate daily what percent of stocks are in long-term uptrends. This is the first significant uptick that we've seen in a year. Arguably, you can see from the breadth models that there has been internal correction going on in the market for over 12 months. Let's look at NYSE. The NYSE bullish percent, or all of the stocks in the NYSE that are in uptrends, the bullish percent has been falling through the course of the last year. Got to a low in the end of January, when the S&P made its first low. When the S&P rallied and made a lower low, actually fewer stocks broke down. That was the first higher low. And now we've made the first higher high. So again, in the beginning of the year, 34% of stocks in uptrends in the NYSE. As we sit today, 50% of stocks are in uptrends. The average company is doing better. Let's look at some of the short-term indicators. Percent of stocks trading above the 50-day moving average in December was only 22%. And since then, on each successive sell-off, fewer and fewer stocks were breaking down below their 50-day. As we sit today, over 50% of all the companies in the NYSE are trading above their 50-day. That's a lot better than what we saw in December, despite the news flow. Percent of stocks with upward trajectory or positive weekly momentum hit a low in December at 16%. But since then, in February was 32%. In early March was 44%. We're sitting at 62%, almost 64%. So these internal indicators tell us that the correction may have run its course. Now, there's no guarantees. We know that there has been weakness in sentiment. There's been some pullback in the market, but actually the sentiment around the economic data is not matching the negative sentiment in the market. That's another piece we have to take away. Finally, let's look at indicators of stress, the US Financial Stress Index. This is a degree of tightening in financial conditions. This is a real tightening. This is what happened going into the pandemic. This is the tightening that happened in 2015-16 correction. So far, there has been some tightening, but again, not terrible stress in financial markets, and certainly nothing like we saw heading into the financial crisis. So to me, this looks a lot more like correction in a bull market, and the internal data would tell us that perhaps that correction is over. Let's look globally. We showed this chart a couple of weeks ago. A lot of countries in the world had negative breadth. But when we look at it today, all of Latin America has turned positive. Even Europe, right next to the Ukraine, has turned positive. Asia Pacific has turned positive. And all US has turned positive. Even China, which has been going through its difficulties, breadth has turned positive. So this is like a traffic light system. When it's all red, we want to be cautious. When it's green, it tells us at the equity asset class level in these various geographic regions, we're seeing improvement. So it gives us the green light to consider putting on new positions. Now, fortunately, most of our themes held up incredibly well going through this period of bumpiness. But nonetheless, it tells us that conditions are getting better. If we look at Canada, for instance, the TSX 60 actually today trading at new all-time highs, and certainly has been relatively outperforming the S&P. Interesting for us, Canadian market's been one of the best performing markets in the world. So let's go back and take a look at leadership. Leadership really isn't changing. Energy, of course, you can expect with higher oil prices, has been seeing rising relative price strength versus the S&P. This is the XEG, the Canadian oil and gas sector, trading virtually at new highs today. If we look at some of the leading stocks, Canadian Natural Resources making a new high, but again, I want to go back and stress, remember, we've been in a bear market in energy stocks going all the way back many, many years. Canadian Natural Resources made a near-term high in 2007. It challenged those highs again in 2011. It challenged those highs again in 2014. This has been a bear market. But while energy stocks as a whole have only recouped a small fraction of what was given up in that 90% sell-off from 2014 to 2020, Canadian Natural Resources making new all-time highs, having just broken out of a major bear market. My guess is after this kind of consolidation, this can go markedly higher. And that would make sense given the fact that they have close to 100 years of reserve life with a very slow decline rate. Outside of oil and gas, uranium has come out of a long-term bear market, broken out, retested, and is moving higher again, led by companies like Cameco, making new all-time highs this week. Outside of energy, the mining sector really is on fire. We've talked about this now for a year. If we go back to 2014, the metals and mining sector, which includes base metals and precious metals, made a significant low in 2016, a higher low in 2020, broke out and consolidated for almost a year, bored some investors to death, but now it's clearly breaking out, and I believe is into the next major leg higher in prices. Remember, it takes a long time to put a new nickel mine into production. It takes a long time to put a new copper mine into production. And when you take supply out of the market, that doesn't look like it's coming back anytime soon, that can give real pricing power. And these are the things we want to take advantage of. First Quantum is a great example, breaking out of a range going back to 2011 and really only just beginning this next leg. Freeport-McMoRan, which we talked about regularly, Teck Resources. There's a handful of companies making new all-time highs. And in the gold mining sector, a sector that's not near its highs, Newmont Mining breaking out of a range going back to 1991. So I don't want to underestimate how powerful these chart setups are. I think that these can go a long way, and they can certainly pull back. But if you look almost anywhere in materials, it's the same picture. This is the steel sector. This is the ETF SLX, made up of companies like Nucor, Cleveland-Cliffs, Stelco, broke out, consolidated, and has now headed higher. And we've talked a little bit about some of the companies that we own, but right here in Canada, Stelco acting particularly well. Agricultural commodities continue to perform well. In the past week, this is the companies in the agricultural sector. So it includes things like Mosaic and CF Industries and Nutrien. After a consolidation that went on many, many months, the group has just taken off. So really all the way across materials and energy, we see strength. And we don't think it's near-term strength. We don't think that it's event-driven strength. We think that really there is a significant shift taking place at the asset class level. And we got to a point where materials made up 2% of the S&P, energy made up 3% of the S&P, and these are important building blocks for the global economy and ones that really can benefit in a more inflationary environment. Going back to other key leadership groups, the banks continue to act well. This is the Canadian banks trading above all long-term moving averages. Earnings continue to improve. Dividend growth is solid and not expensive relative to the rest of the market. We talked a couple of weeks ago about the aerospace and in particular the defense stocks, Raytheon, Lockheed Martin, Northrop Grumman. These are all companies that will benefit from an increase in spending in the US, an increase in spending in Germany, and sadly, many, many other countries around the world who are going to have to increase their spending. These companies have contracts that are inflation protected and likely to have added business given the circumstances in the world. Last few groups, consumer staples. Companies continue to be able to tack on price to offset rising costs. The group continues to act well. Dividend growth is the theme for income investors. The FDL Morningstar Dividend Leaders ETF making new all-time highs today against quite a sloppy market, certainly continuing to outperform the high dividend paying stocks in the SDIV. So dividend growth over high dividend continues to be leadership. And in the end of the day, we have to pick our spots. We don't have to be in every sector. Our job is to really do our work every day, understand where breadth is improving, understand where breadth is deteriorating, be willing to take from the weak to add to the strong. We want to have portfolios that are relevant given the current climate. We're always looking for new leadership. There's not a lot of new leadership showing up. There is improvement in some of the underperforming groups, but frankly, we aren't going to go out on a limb after a major sell-off in tech, for instance, and build big tech positions when they're trading all below their long-term moving averages. But there are things to do. So from a cash perspective, we're fairly fully invested. Let's look at sector weights. Our energy weight remains about 20%. So this is where we were about 2 weeks ago. A month ago, we were at 16%. Our job is to add to strength. Financials, we took down a little bit because we wanted to increase our weight in materials. And materials are now 20% of the portfolio. But remember, this is across agriculture, metals, alternative energy, materials of all types, including things like steel. Consumer staples, we're a little bit overweight market. Real estate, there are some areas of real estate trusts that are giving us excess dividend growth, which we think makes them attractive in this environment. But look at this, we continue to be way underweight technology at only 5%, where the S&P is 27%. Industrials, we are close to market weight, but it's almost all focused in aerospace and defense. Government and corporate bonds remain very small weightings in the portfolio, and they're short-term in nature. Telecom, significant underweight. Consumer discretionary is significant underweight based on the fact that oil is going to be a drag on the consumer. And healthcare, where their ability to raise price relative to inflation is going to be difficult. Outside of the US, there are other parts of the world that are performing better. And that may be because they have significant energy or basic materials exposure. And certainly Mexico would fit there, making new highs today. Latin America moving sharply higher, and certainly Saudi Arabia. Outside of that, countries that have a significant financials or banking sector tend to be outperforming. And I'd highlight Indonesia, where we can say a number of the major companies in Indonesia are bank related. And of course, in a country like Canada, where we have both large banking sectors, large basic materials sectors, and large energy sectors. It's not for us to say what we think should be happening. It's for us to say what is happening. I know the team has worked very hard through these last few weeks to check and recheck what we're seeing coming out of these breadth models. Were we seeing deterioration in leadership themes, you would have seen us talk about having significant cash weights. But while there have been significant pockets of weakness over the last number of months, there are these very extraordinary pockets of strength. When we look at our macro portfolio, it is a very skewed portfolio. Precious metals, materials, energy, commodities. Canada is almost 17% of the portfolio, when it only makes up about 3% of world markets. Emerging markets has been bumped up to 17% of the portfolio. These are things that we don't own in other portfolios. Financials, an important weight at 14%, dividend growth at 10%. And we still have a significant weight in the cryptocurrencies, Bitcoin and Ethereum, which have been showing steady improvement over the last few weeks. On the other side, while I know it's counterintuitive, we have been short the bond market. US government bonds, global corporate bonds, and mortgage-backed securities means we benefit as rates go higher and bond prices go lower. And this may not be a short-term issue. Remember, bonds have been in a bull market for 40 years and have only just recently gone through this shift. Now, about 4 weeks ago, when Russia invaded Ukraine, we talked about the history of geopolitical events and the size of the sell-offs that came along with them. right? When Germany annexed Czechoslovakia, the market sold off 20%. But 6 months later, it was up 23%. When the Cuban Missile Crisis took place, the market sold off 7%. It was up 22% 3 months later. When the 9/11 attacks took place, the market sold off 12%. 3 months later, it was up 18%. 6 months later, it was up 20%. In general, the market works its way higher after the initial shock of the event. Now, last week, we had 4 days where the market was up over 1% after completing possibly a sell-off that began in tech starting in February of last year. When you got that kind of bread thrust historically, look what happened next. Well, we've had this happen only a few times. And when they happened, look what happened 6 months out. So 3 months out, the market was up 75% of the time. In 1974, it was down 1.5% 3 months later. But 6 months out, it was up 18%. In fact, in all cases, in the 4 previous occasions where the market went up 1% or more 4 days consecutively, the market was up 100% of the time 6 months later, an average of 16%. The numbers are even more compelling when we go out 12 months, again, up 100% of the time. On average, the market was up 28%. It's really important that we don't get caught up in sentiment. I know we've fielded a lot of calls from clients very concerned about what's going on in the world, and I get it. It's an uncomfortable thing to pick up a newspaper or to watch the news, given all the things we've been through over the last 2 years. But what's most important is to understand the range of possibilities. What are the things that can happen and have a plan as to how to deal with them? We have stop losses on all of our positions. If our breadth models turn down, we get more defensive. But as it sits right now, the evidence is that things are getting better. And I think we're positioned in the right places. Despite the fact that the market was down 14% and the NASDAQ was down 20%, it's certainly rallied now off those lows, but the S&P is still down about 7% on the year. Our equity pool is down 1%. We don't ever like to be down money, but down 1%, not so bad. Balance pool is up 1.3%. Our income pool is down 4%. And our macro portfolio is up just a shade under 12% on the year. So we're having a good start to the year. We think this positioning can work going forward. We're going to continue to watch for changes. And if required, we certainly will get defensive because that's what we do when things get difficult. With that, if there's any questions, Pam, happy to answer them. But as always, please follow us on Twitter at Barometer CA. If it's useful, we're going to do a BNN tomorrow morning at 9:10 for sort of 10 or 15 minutes to answer some questions there. But if you've got questions now, certainly happy to take them on.
Thanks so much, David. Just a few questions here. Are you still bullish on forestry stocks? Lately, WFG has been beaten up. Any comments?
Yeah, so it's a two-way street on forest stocks. So if you take a look at the WOOD ETF, so that's lumber. It certainly came out of the bear market in March of 2020 and rallied. It consolidated over a period of months and has broken out since then. And against a very tough tape, frankly, if we look at it year to date, it's up, I guess, a few percent. So I do like the group. Now, there's no question that housing stocks are having some difficulty given the very sharply rising rates. The cost of a mortgage, I think, is up about 23% so far over the course of the year. That's going to hurt some people. But at the same time, with the basic materials group, lumber pricing continues to be pretty strong. So you have to pick your spots, but no, continue to be bullish in this group.
Thanks, Dave. Can you speak to why Barometer has recently decreased its allocation in financials?
Yeah, great question. It's always a tough one when we have well-positioned portfolios, but some new leadership emerges. So it's a lot less about whether we think financials can do well, but we have to consider the evidence. Canadian financials continue to act very well. In the US, there's been a sharp increase in the price of gas, so that may impact consumer, and the consumer stocks are acting a little bit more poorly. On the other hand, we've seen a sharp pickup in the defense stocks. So we certainly have added to things like Raytheon and General Dynamics and Lockheed Martin. And, it's really working. And I'm not saying that the US banks don't look good. This is the regional banks index. So if we take them over the last 2 weeks, they're about sideways. And they're really not far from the highs. They're trading above their 50-day, 150-day, and 200-day moving averages. But we have about 17% in financials. It's not an inconsequential holding. But we didn't have anything in defense. And I think it's very clear that defense spending is going higher everywhere in the world. Look at the response from Germany, who battled with NATO over spending on their military, and almost overnight, universally changed their view and agreed to take their spending up to 2% of GDP, which is about 100 billion euros. So we think that this is an important change that's going on in the world. We have to react to it. And we think that holding companies like General Dynamics and Raytheon makes a lot of sense. It's not so much that we don't like financials. We really like financials. That's the insurance sector. But there's other things that we can do to diversify the portfolios from different kinds of risks.
Thanks so much, David. Vern wants to know, if he wanted to increase his investments in commodities, is there a single ETF that you might recommend?
Well, there's a couple, and we've talked about them over the past few weeks. Let me just see if I can put it up here. Let's see here. GUNR is an ETF that owns large cap resource stocks. The yield is about 3.3%. It's been growing its dividend at about 10%. So it fits both a dividend growth theme and an inflation protection theme. I quite like this, and this includes companies like BHP and Rio Tinto and Teck Resources and companies like Nutrien and CF Industries in the fertilizers. So this would be a really good one. But certainly our global macro portfolio wouldn't be a bad one either.
Did you hear that, Vern? Give us a call. Dave, as always, we appreciate your insight and guidance. Certainly our viewers enjoy tuning in every Tuesday to hear your perspective. So thank you so much for another enlightening afternoon. We look forward to seeing you tomorrow on BNN. And with that, I'll leave you with the final word.
Yeah, thanks, Pam. Look, this has been, I think, for a lot of people, a particularly trying time. We've just been through 2 years of COVID. We've got a major bout of inflation going on, and now to add a world conflict, global conflict at this is particularly difficult. We have to kind of try and keep our feet on the ground, and we have to use process to our advantage. The world's going to keep changing for sure. All of these groups and companies will at some point pull back. But I think that the setup right now in some of these major shifts is that they're going to go on for a while. So if you're on the wrong side of something, I would really encourage you to take it seriously, because some of the changes that are taking place could be set up to carry on for quite some time. So it's an interesting time. It's a great time to be a targeted active investor. It's a great time to have an opportunity to rifle shot. So we're looking forward to the rest of the year. Keep in mind that this weakness in the market started February of last year, and it slowly worked its way through a lot of groups. Some of the groups were able to skate through. While I can't say with certainty that this correction's over, it sure looks like it based on our indicators. And that could mean that, like in those other cases when we had a big breadth thrust over 4 days, we could be going a lot higher here, despite the concerns as to what higher prices can do to the economy. You have to remember that one of the major risks outside of falling prices is inflation, and that your cash gets deflated or inflated away. And so we need to own assets right now that can hold up against inflation. And I think most of these groups that we're talking about here very clearly are showing they're holding up against inflation. So with that, thanks everybody for tuning in. And if you've got questions you weren't able to ask, please forward them on either by email or text, or give us a call. If you'd like to have a conversation, I'm very happy to jump on, as would any of our investment counselors. And other than that, we'll look forward to seeing you again next week.